You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the Infinite Banking Mastery Podcast. Today, I wanted to talk a little more deeply about the options you have for saving that you will be able to access your money income tax free. You really only have two options. That would be a Roth IRA or life insurance. And that's certainly not term insurance. That's cash value life insurance. And as you very well know, my preference is whole life. Roth IRAs are very popular due to their tax-free growth and tax-free withdrawals that you're able to access at retirement, and that's great. However, there are some significant income restrictions that you should be aware of. If you're single and your modified adjusted gross income exceeds $165,000 in 2025, you are ineligible to contribute to a Roth IRA. Whereas if you are married and filing jointly, you cannot contribute if your modified adjusted gross income is over $246,000. To make a full contribution, your modified adjusted gross income must be below $150,000 for single filers and under $236,000 for married couples filing jointly. These numbers I'm giving are for 2025 because every year they do change a little bit, so you have to keep your eye out on what those numbers are for in any given year. So assuming your income falls below the annual threshold, you can fund a Roth IRA. However, there are limits to how much you can contribute annually as well. And these limits are also, they're set by the IRS, and they also can change every year. For 2025, you can contribute up to $7,000 per year. Unless you're over age 50, then you're able to contribute up to $8,000 a year. Now, for someone or a couple making pretty good income, this is a really low contribution amount that you're even able to contribute to an IRA. Of course, you may not even qualify if your income's too high, but if you are on the higher end and have that higher income, say $230,000 for a married couple, and you're only able to fund $14,000, $7,000 per person working, well, that's about 6% of your income, but maybe you wanted to save more than that, more than 6% into an investment vehicle that would allow you access to income tax-free dollars in your retirement. So it doesn't allow you to save as much as maybe you would like. You do have some flexibility when it comes to accessing your funds within a Roth IRA, as you can withdraw your contributions at any time without penalty. However, early withdrawal of earnings may be subject to taxes and penalties unless certain conditions are met. Being that I'm not a CPA, I don't want to go into all the conditions. It's just important to know that the withdrawal would have to be for a qualified reason to be able to access your earnings without tax and penalty if you want to pull those earnings out before you reach age 59 and a half and before you've had your account at least 5.5 years. Regarding the safety of your Roth IRA savings, of course, these funds are invested in the market and therefore are subject to stock market risk. The value of your investments will fluctuate based on market performance, which can impact your retirement savings. Your Roth IRA invested in the market will have unlimited growth potential, and it will also have significant loss potential. So it really depends on how well you can stomach that loss potential when you're trying to determine if this is one of the ways you would like to save for your retirement. Now, when we compare this with saving into life insurance, whereas Roth IRAs have income restrictions you have to pay attention to and figure out calculations. If your income is in the gray areas of earnings between $150,000 and $165,000 for single filers and $236,000 to $246,000 for married filing jointly. And then, of course, these numbers are changing every year. When it comes to life insurance, you can fund a policy with almost any dollar amount you want. There are no income restrictions. Now, I have mentioned before that there are restrictions such as on how much of your total income you can fund into a policy, only because underwriters will wonder how you can afford a policy if you're trying to put, say, 50% of your income into it. But other than that, you have a lot more room to fund at a higher level. Usually that doesn't become an issue for someone because they're able to save as much as they want to without hitting those underwriting restrictions. When it comes to tax-free growth and accessing your funds, of course, we've talked about this a lot on this podcast, or at least I've talked about this a lot on this podcast. The cash value of life insurance policies grows tax deferred and also is accessible all your life, income tax free, super awesome. So long as your policy was structured and managed correctly and you are accessing the funds correctly. When thinking about your future, it is so important, I think, to make sure you have an account that you can access income tax free. Always remember that when it comes to retirement accounts, it's like having Uncle Sam as a business partner, except this business partner can change his partnership percentage of your account whenever he needs more money. With our country's ginormous debt looming over us and the fact that our country spends way more than we bring in, it only makes sense that Uncle Sam would have to take more of our money in the form of taxes. And if they raise your tax bracket, any income taken from your retirement accounts will have to pay taxes at that higher rate. Now, moving on, Roth IRAs will experience stock market risk, whereas your whole life insurance contract will experience no market risk, my favorite, but instead will experience guaranteed cash values and dividends, so long as your policy is with a mutual company. Some of my other benefits to whole life are the legacy you will leave your family. So if you have $100,000 in your Roth IRA versus $100,000 in your life insurance policy and pass away, your family would receive the $100,000 from the Roth IRA versus, say, like $1 million death benefit from a whole life policy. Now, of course, that depends on the age that you acquire the policy, how long you've had it, and how much the 100,000 buys because of your age and all of that. But still a sizable death benefit as opposed to just the value of the Roth IRA. And side note, if you leave your Roth IRA to someone other than your spouse, they will be required to deplete that fund by the end of 10 years, within 10 years. Of course, another major benefit would be the ability to utilize the infinite banking concept and borrow against the growing equity inside your policy, while your funds continue to grow, experiencing uninterrupted compounding interest. You're able to borrow at very low rates, fixed or variable loan rates, your choice depending on the company, and low fixed loan rates are guaranteed the rest of your life. And with the flexibility to pay back the loan whenever and however it works best for you. And then there's the critical, chronic, and terminal illness riders, which I talk about all the time, that gives you access to a portion of the death benefit for a critical illness, up to 50% of the death benefit for a need that qualifies for long-term care. In order to trigger that rider, you would have to be unable to perform 2 out of the 6 activities of daily living. And then there's also the benefit where you would be able to access up to 75% of your death benefit for a terminal illness. Now, different companies have different amounts that you can access and different tweaks to these riders. Some don't have all 3 categories. It just depends on the company. But there are just so many more good things to me when I'm considering, do I want to save dollars into a cash value whole life policy, a dividend paying policy with a mutual life insurance company, or would I want to invest some money into a Roth IRA? I'm choosing whole life all day long for myself. So in summary, while Roth IRAs do provide some flexibility and tax-free growth, they come with income and contribution limits. On the other hand, life insurance policies offer steady, tax-deferred growth without income restrictions, along with the added benefit of a death benefit to protect your loved ones, access to your cash anytime without restriction, guaranteed cash values, the ability to borrow against your cash value while it continues to grow uninterrupted, and other living benefits. So if this is something you are ready to look into for yourself, whole life insurance and how you can begin implementing the infinite banking concept, and you would like to partner with a knowledgeable IBC practitioner and coach, feel free to reach out to me. You can reach me at Valerie@alphaomegawealth.com. I would love to meet you, help you get started, and become your IBC coach for your financial success. Thank you so much for listening. Have a wonderful week.
This is thepodcastfactory.com.